Hello and welcome to episode 4 of Damien's Midweek Markets, the podcast where I tell you everything you need to know about DIY investing, engaging you with what is going on in the market right now, what might go on in the future, and to help you invest your own money and make informed decisions. Now, this week, wow, what a week. In terms of the investment backdrop, you may remember at the end of last week's podcast, I talked about a few key events that were going to occur in the days after that podcast. And one of the big ones was the US Federal Reserve. Now, the US Federal Reserve are the equivalent of our Bank of England, and they met and made their latest interest rate decision. So that meant that they decided to keep rates on hold. That was widely expected. But if you recall, in the December sell-off of equity markets, one of the biggest catalysts of that sell-off was the Federal Reserve hinting that they were going to start raising rates perhaps more aggressively, but also putting their unwinding of QE, that quantitative easing, that money printing, they're going to start unwinding that, and they call that quantitative tightening, QT for short. Now, there's been lots of concern about this because if we start withdrawing all that liquidity, it means that the market, a market that has been fueled by easy monetary policy, so low interest rates and lots of money floating around the system, pushing asset prices up, and in particular stock prices, if that gets pulled away, then it will deflate the air out of the bubble that is the stock market to effect. What happened is that everyone was watching what the Federal Reserve would do, but also what Jerome Powell, who is the chair of the Federal Reserve, what he would say, because a lot matters about the conference that happens after that, the press conference, where journalists ask questions, because they sometimes trip these central bankers up, or they get a little bit more information that isn't in the official statements. And to say that they were dovish in terms of, when I say dovish, I mean that they are erring on the side of keeping rates low for longer, that would be an understatement. They went the whole hog. They almost completely U-turned, and we've now got to the point where the market is even expecting some more QE at some point in the near future, because the central bank started to admit that the world economy was looking pretty shaky, and there was in effect a possible knock-on effect to the US economy. And in fact, so we've had 3 rounds of QE in America, so the market is now thinking about QE4, or one phrase I saw out there, QE infinity, i.e. we'll never get off this low rate or easy monetary policy. So that was music to the market's ears, and the market rocketed. If you go and get your stock app out, go and look at the S&P 500, it rocketed, and that was reflected across pretty much every stock market globally, because always remember, where the US tends to go, the rest of the market tends to follow. It isn't always true, but it is a general rule of thumb. So everybody's watching what the Fed is doing because of the size of their QE, because of the size of their economy. It matters. And the stock market rocketed, and what we've got now is that the market is leading the Fed. What would usually happen is the Federal Reserve and all central banks are meant to be independent, and what they do is they look at the economy and they look at economic figures, and they try to tighten or loosen monetary policy, pull those levers to try and keep the economy going. They're not supposed to look at the stock market or be led by it, but of course they'll keep an eye on it, because sometimes the stock market can be a little bit of a barometer that there are some stress signs in the background that haven't come to the fore. And what we've got now, it looks like the Federal Reserve is just pretty much looking at what's going on in the US stock market, almost to the point that it's laughable that the 2,600 level was the point where they panicked and hit the panic button and dovish and started telling the market what they wanted to hear, that the Fed has got their back. We've now got to the point where they've gone ultra loose, and it's almost like we're going to keep pushing prices higher. So the market's interpreted that as buy the dip is back. The investment strategy that has worked for the previous 9 years of QE and post that financial crisis, it was basically buy any dip in the stock market. Don't worry, it's always going to go up. At the end of 2018, that backfired and it started to not work, and it started to be known as sell the rip. So every time the market fell and it looked like it was going to rebound, you'd sell again because it's going to head lower. And that was because people feared that QE tightening, so QT. We're now at the point where the market seems to be leading the Fed. What is going to be interesting going forward is that the US Federal Reserve and Jerome Powell is now getting a lot of stick about this and saying they capitulated, they blinked. And if at some point he's going to try and reassert the fact that he is independent of the market and doesn't care, then you're going to get another sell-off, because he's going to say something the market doesn't like. And the market has now rebounded and gone through that 2,700. You will notice I talk a lot about the US market, but it's because at the moment it's the one that's really leading what's going on and everyone's focusing on. 2,700 last week, I mentioned on the S&P 500 index, was key. We got above that, we crept above it, we hung above it, we sort of bobbed around for a little bit, a couple of days, and then we broke higher again. And some of that was because we had some good earnings figures as well. So I mentioned people like Facebook and Amazon, and the numbers that came out of a lot of those, what they call FANG stocks, they were either good or they weren't bad. And so the earnings season has not disappointed to the extent that people thought it would. Now, I've got to caveat that. They've set the bar low because lots of these companies have actually already lowered the expectations of the market by making announcements earlier in the year, which caused a bit of a stock market wobble. But it's like a high jumper who sets the bar even lower so he can definitely get over it. That's kind of what we're seeing, a bit of that. And of course, as long as they get over that low bar, the market is being positive. So we're at a case now where the market has managed to not only get above 2,700, it's been creeping towards 2,740. Now, just above there is the 200-day moving average. And I talk about that 200-day moving averages before on lots of markets. You have 50-day ones, 100-day ones, whatever you want. But at the moment, 200 moving day average is proving a battleground, the next battleground for the bulls and bears. Because to really negate the chance that the market won't retest the lows that we saw in December, the stock market really needs to push above and close above that 200 moving day average convincingly. Because even though some people may not focus on moving averages, a lot of traders do. So being below that 200 moving day average is seen as a bearish sign that the market, the trend is lower. Now, what we want to see is it go above there and close above there to show that, yes, the longer term trend is starting to move back up again. And keep an eye on that this week. Keep an eye on what we do. What has been interesting, there have been 2 occasions since the October sell-off. Get your stock app open and go back 6 months on it. You'll see there were levels where we got to around 2,800 where the market hit and then sold off, and then it eventually rallied back again to that level and then sold off. That is the next level for us as well, so 2,800, but equally, or just above there, equally that was the 200 moving day average at that point, back in the October, November, December. The 200 day moving average is a little bit lower now, say, like I said, 2,740. So this area between 2,740 and 2,800 looks like it's going to be very tough. If the market gets higher, it may limit how high it can go before it gets the next battleground. So if we look at what happened in those previous instances, the market sold off once it hit that 200-day moving average because of how it behaved. What we've seen is the market is rallied so strongly, so quickly, that I think it's about in the last 28 days, we've had 25 that are positive. It's very unusual. And we've had some of the best starts, the best January, in fact, for 30 years. Incredibly unusual. So that means the market is due a bit of a breather. And what you may see is it's interesting to see how the market will behave around that moving average. One other thing to bear in mind is that you may see headlines talking about overbought or oversold, and they are it's an index or a measure that people use. Don't dwell on it. It's not too important to understand exactly how it works, but it's a relative strength index that they have. And it's, if you think about it, if you have the market keep moving in one direction too long, so like it really sold off just ahead of Christmas Eve, so it went down almost continually for a couple of weeks. Equally, the market has done the opposite since New Year, almost gone continually upwards. When you get that, then there's almost a level of exhaustion. So in the Christmas Eve period, it got to the point where it was oversold. Basically, it'd gone too far, too fast, and that was downwards. When you get that, sometimes it can be an indicator that the market will reverse. So it's basically been exhausted, the selling, and then it will bounce. That's what's happened. Where we are now, we're back at overbought levels, which can be an indication that the market might change tact and move in the opposite direction for a period of time. It did that Last time it was this overbought was in September, and you can look at your graph and see the market collapsed after September. It's not to say it definitely will happen, because markets can be overbought or oversold for a period of time, but it's just another thing to bear in mind. If you listen to the commentary out there, it's all, we're going for the stars, the market's only going higher. But as I've been mentioning, we've not yet fully confirmed the downtrend has disappeared. We're almost there, but we haven't 100%. The other thing to look at out there and bear in mind is the US-China trade deal talks that have been going on. They finished, the latest round finished last week to no conclusion. There are going to be some more. The US government is likely to shut down again in February in the coming weeks because Trump still can't build his wall. These are all negative signs. These are all negative winds out there that could cause a problem. If you think about the market, there have been lots of negatives. Earnings has been one, but we bumbled through it really, and it hasn't been as bad as some people think, although it's still unfolding. But the earnings expectations are being lowered, so again, that isn't necessarily a brilliant thing. The global growth numbers are still disappointing. Italy has gone into recession, so that in the backdrop again is a negative thing to be looking at. But in terms of the Fed making a U-turn, that's a huge positive in the market. If we get a China-US trade deal, that will be another one. It will almost be completing the key problems and headwinds out there, because don't forget the trade tensions are causing some of the background issues with global growth as well. Another thing to look at is Brexit. We're now seemingly getting into crunch time. Keep an eye on the pound. The pound has fallen back below $1.30, which seems to be a very strong resistance level. Once you get above it, it acts as support. If you go below it, it acts as resistance. And there are now signs that we may be heading more towards a no-deal Brexit. Keep an eye on how it's moving up and down, that pound to dollar ratio, because that is the best indicator really of what the market is most fearing. And if the pound goes up and strengthens against the dollar, it means that the no-deal Brexit is less likely, and we'll probably maybe get an extension or a new referendum. If it falls, it means a no-deal Brexit is looking very likely. So keep an eye on those. The FTSE 100, before we wrap up, has been showing some interesting signs of strength. We broke above 7,000, which was a key level, above 7,100, and we were heading towards 7,200. Now, 7,250 seems to be an interesting level on the FTSE 100. If you look at your stock app again, you will see when we get near those levels, we can very quickly kick on towards 7,500. We're quite a bit from breaking that level and kicking on, but it has rallied nonetheless, so keep an eye on that. And some of that is the weakening pound boosting the FTSE 100, and that correlation I talked about in the past that had broken in recent times, that has started to come together again. So there are a lot of moving parts again in this week in markets. One thing to also have a look at is in any market there are sometimes signs of strength in different sectors. I've been asked it before, are there sectors that do well or don't do well? In the current environment, if you look in America, the REITs, which is real estate investment trusts, which tend to invest in property and lease property, they have been outperforming other sectors and they've shown a relative strength. That doesn't mean when the market tumbles they don't tumble, but the reason they have is because when bond yields fall, so bonds are those relatively safe investments, but when the yields on those fall, so the income you're going to get starts to tumble, investors start to look for alternatives. So they start looking for bond-like investments, so they're going to give a return. So that means a lower risk investment, and often people turn to property, so rents on property, and as a sort of quasi or next stage up bond type investment. So those REITs, those funds that invest in property and property shares, have done well in America relative to the rest of the market. So that's something to keep an eye on. In the UK, the one thing I will mention before I wrap up are the UK property funds. There are different types. There are those that invest in equities, so they invest in things like house builders. They're investing in the shares of those companies. They are very different to funds that invest in bricks and mortars. So they actually invest in offices and commercial buildings. Now, you can see that because it's actually been split out now. There's a sector called the UK direct property sector. But even if you weren't sure, if you look at a fact sheet of a property fund and see what's invested in, it will list the addresses of those places if it's a direct property fund. If it's not, it will list the names of the companies it invests in. Now, one of the key things with Brexit coming up, property funds that invest in buildings and offices may come under pressure. I've had conversations with people in the industry related to these funds that people are starting to pull money out of some of these funds, and when they do that en masse, the problem is you can't sell half an office, so they have to sell the whole thing, or they have to just stop people getting their money out. Now, that's already been showing signs of happening. It happened after Brexit, and if you remember, so I say Brexit, I mean the Brexit vote back in 2016, and what happened is that people got locked into funds for a period of time. We could get a repeat of that now, so I'm just warning people, have a look. If you've got property funds that invest in direct property in the UK, do look. I've started to notice some of them are showing negative returns over a 1 month period, which is something to bear in mind. So that is it for this week. As ever, contact me, Damien, at moneytothemasses.com. You can get me on Twitter, money to the masses with the number 2, and obviously follow me on Instagram and talk to me on Instagram, and you can request what will be in next week's show. So until next time.